Well, hello, everybody, and Happy New Year, and welcome to another edition of MGO's Investment Market Update. I'm Michael Moskal, Director of Investments, and I am here today with two of our advisors, Brad Wingler and Parker Kasgan. And we're going to dig right in and talk about 2025 and what we see going to be happening. And we'll talk about four different topics today. One is going to be infrastructure, because that's an area of investment that we're looking at to be investing in with our portfolios in 2025. The AI revolution, which was big in 2024, we think that continues in 2025. Deglobalization, which is the picture of the people walking away with parts of the globe on the upper right-hand side over here. And then what Donald Trump and his presidency can mean for the economy, which sort of intertwines with what we just talked about here. First of all, we want to say happy 86th birthday to MGO. Our company was started in 1939 by a gentleman named E.M. Klein back in those days, and we're in our fifth generation of the company. And of course, we have 6 advisors on our advisory team. Like I said, we got 3 of us today on the call. But if you add up all our experience, it's 159 years of experience in the investment area, which I didn't know we had so much experience, but that's great to know. All right, let's take a look at market scorecard and see how markets have been performing in 2024, how they did. What I did is here is bolded the last half of the year, which was July 1st. And because we did have something happen from July 1st that we didn't have in the prior months prior to that, which was we had more participation happening from all the stocks in the stock market. If you look at the NYSE composite index right here, which is including all stocks in the New York Stock Exchange, well, up 5.7% for the last half of the year. The Bloomberg U.S. Government Credit Index, which is bonds, we're up 2.1. Our MGO equity ETF portfolio performed very well for that last half of the year in 2024, up 8.2%. Dow is up 8%, S&P 7.7. The S&P 500 index, by the way, we almost consider that a mini technology index at this point, because almost half of that index is now made up of technology stocks. And DJ Global XUS are foreign stocks. Foreign stocks have been a very unfortunate part of the market the last really number of years here, as money is just flooded into the U.S. stock market, really because of the whole AI revolution and the big cap tech stocks like the Amazon, Apple, Googles of the world, NVIDIA, of course. That's where the money has been flowing the last number of years and not into internationals. Although that intrigues us because international stocks have gotten very, very inexpensive. And that's an area probably in 2025 we're going to be looking at expanding more into. Brad, you want to talk about gold a little bit?
Yeah, gold continues to be strong. Gold is actually the number one, the only asset class that has had positive performance over the last 3 years in a row, and just continues to be strong year after year for the past several years. Lots of different reasons for it. I would say the top 2 reasons for the strength in gold is, number one, uncertainty around the world. There's a couple of wars going on. When you have uncertainty, people tend to flock towards gold. And also you have a lot of big countries, big sovereign nations, United States, Europe, China, places in Asia, printing just gobs of money. And when you have fiat currencies that are inflated, people tend to rush to gold at times like that. So may continue for a while.
Yep, absolutely. That's very, very true. Parker, what about Bitcoin? Bitcoin's been hot lately.
Yeah, so the question I get from a lot of our clients is, is there Bitcoin in my portfolio? And the answer is directly no, but some of the underlying holdings there is. So if we take a look at the MGO equity ETF portfolio, second largest holding in there is the Schwab US Large Cap Growth Fund. And there's 4 companies in there that own Bitcoin directly, and those are MicroStrategy, Coinbase, Block, and Tesla. MicroStrategy is the biggest holding of Bitcoin. They own over 400,000 Bitcoin, and it's about 2.5% of the whole supply of the Bitcoin market. So you don't directly own Bitcoin, but there are holdings within your portfolio that do own Bitcoin directly.
Yeah, Bitcoin is one of those interesting areas because, at one point in time was considered to be sort of like an alternative to gold. One thing I think we do agree on as an advisory group here is that Bitcoin's not going to be used widely as a currency.
Right.
It is being used in the underworld a little bit, as we know, Russian hackers and things like that. There was a country, was it El Salvador? There was a Latin American country that actually adopted Bitcoin as their currency, right as it went down 50%.
Mhm.
So, but it is a legitimate asset class. There's many ETFs that have Bitcoin ETFs as well as other cryptocurrency ETFs. But cryptocurrency, in our view, it is an asset class, and it may be a more speculative asset class, as you can see with returns in the bottom of the chart here. Minus 78%. We got to remember it can go down like that as well as go up 150%. All right, one of our themes, deglobalization. America First policy, which was Donald Trump is calling it America First. And this is a theme that's actually been happening really starting in 2019, trying to really focus more on bringing companies back to the US, making more things here, trying to protect domestic industries, which is good for a more secure economy. And it also increases jobs here in the US. One thing that really kicked this off, by the way, was COVID. And I think when COVID happened, we all discovered that the vaccines that we needed, that none of it was made here in the US, it was all made in China, or somewhere else. And that really kind of woke everybody up to say, well, maybe we shouldn't be so beholden to foreign countries. But so this deglobalization has positives and negatives to it. When the wall fell, by the way, in 1989, which of course sort of kicked off the whole globalization, 30 years worth of globalization. If you remember that, when Ronald Reagan got up and said, Mr. Gorbachev, tear down the wall in Berlin, and they actually tore down the wall. They actually got a sledgehammer and they smashed the wall down. And that actually kicked off 30 years of a globalization era where countries were working more together. Global trade picked up. And one thing that does that's very positive, by the way, for globalization is that when countries are making money off each other and they're trading, they tend not to war with each other. They tend not to go to war. So one of the negatives that happens when you start deglobalizing, and again, the cartoon that we had at the beginning of this, actually, I'll just go back quickly. That cartoon at the upper right where people kind of take their piece of the globe and walk away, that doesn't foster a lot of cooperation with countries. And we sort of see that going on now. And not that we're going to be in some major war going on anytime soon, but it just puts a little more pressure on countries, as far as keeping peace. So, pros are you do have a more secure economy, more available jobs, as we said. Cons are pressure on inflation. And why is that, guys, that there's pressure on inflation?
Costs more money to produce the goods when they're produced in the United States.
Yeah, it's cost more, right? So you'd say wages are more in the US than they are, say, in Southeast Asia somewhere, or India or China. So when you have things that are made more in the US, it's just going to cost more, and those costs get passed on to consumers. So it does have an upward pressure on inflation and prices of things, which in turn has an upward pressure on interest rates. There are a lot of companies and stock sectors that benefit from this, whole deglobalization or America First. And we'll talk about small caps in a little bit, but, just take an example of a company like Intel, and that's sort of in our heart right here, because down in Columbus, Intel is building a number of campuses actually down there to build chips, computer chips. So they are getting, I think, Brad, what was the number? Was it 10 billion?
Yeah, they're getting about 10 billion from the CHIPS Act, plus a fair amount, somewhere around 15 billion, I believe, in tax incentives as well.
Yeah, so there's quite a bit of money being spent. I think the CHIPS Act itself was about $58 billion. And, a lot of that money is going towards some of the bigger chip manufacturers like the Intels of the world, the Taiwan Semiconductors, which has a big plant in Arizona. They're getting a lot of money from the government instead of farming out their chip production overseas to keep it here. And that graph you see on the bottom right, that sort of tells a story, because chips are not being manufactured in the US. It says America is 8%, but that includes Mexico too. So in America, I think it's something less than 2% of the chips are made in America. The goal from the government is to try and push that number up to 20% eventually, supplanting China and maybe some of South Korea too.
And if you think back to 22, when you had shortages of chips, if you recall, you had it affected a lot of other industries because chips are used in many different products. And so you had, for example, you had car lots where you had cars sitting on the lots and thousands of cars sitting on lots that just needed additional chips that couldn't be provided because we couldn't get them from foreign manufacturers. So that's a big reason for the deglobalization of the chip market.
And that's a great example, Brad. It really is, because that was exactly what was going on. And what that did also was push up prices too when that whole thing happened. All right, another theme is the American Industrial Renaissance. Rebuilding of infrastructure. I know it's been talked about for a lot of years, but there actually was in 2021, there was the $1.2 trillion Infrastructure Act that was passed. Now, half that money has been unspent. So there's about 600 billion, if not more, that's left to spend on infrastructure. And when we talk about infrastructure, we're talking about not just roads and bridges, which was sort of the original thought of this, some decades ago. And that does need to be done, as anybody who drives over, roads and bridges pretty much can attest to. But also things like nuclear power. There's a whole drive right now, and this is all part of the AI theme. A whole drive right now to where we're going to generate more power, because AI, artificial intelligence, it takes an enormous amount of power to generate, and it's not going away. So the question is, where do we get this energy from? And so we need to rebuild infrastructure. And it could be things like data centers. And there's a lot of data centers being built. What was it, Parker? How much is being spent? Microsoft is spending
$80 billion.
$80 billion on data centers in 2025. That's their goal. That's a lot of money. So data centers are the centers that provide a lot of the power that is being given, for artificial intelligence, but the power's got to come from somewhere. So it could be coming from nuclear. Certainly we all know the electrical grids are in dire straits and dire needs of being rebuilt. And that's all part of this. Again, it's all part of the whole energy rebuild, the whole infrastructure rebuild that's going to be, fueling artificial intelligence. And that helps different sectors that we're investing in, such as industrials, materials, energy, transports, kind of filters through to a lot of different sectors and companies that we would be investing in. What's the impact? It's expected to add $15 trillion to the world economy by 2030. Some of that may be a little bit overblown. We've seen this before with new technologies, where it doesn't quite have that immediate impact that everyone thinks it's going to have, even though long term it's wonderful. If you look at new technologies in the past, they go through 3 stages typically. The first stage is the excitement, which we just started having the last couple of years with artificial intelligence. But you can go back to railroads in the 1890s, radio in the 1930s, and certainly the internet, .coms, back in the late 90s, that did change the world. These were real new technologies that happened that did change the world. And AI is going to change the world. It already is. But sometimes it gets into a little bit overblown. That first initial stage of excitement goes into euphoria, which we've not quite, in our opinion, reached yet. Certainly not for the stocks in this area, but it will reach the euphoria stage, and then comes sort of a crash that happens, a washing out. If you look back in the 1990s, the internet stocks back then, 90% of them are not around anymore. So there's a lot of hype that happens. But then the third stage is a sort of a long-term recovery benefit stage that happens. And there are companies that do become the leaders. So if you look back at the late 1990s, what's like an example of a company, guys, that became a leader from the internet?
Amazon.
Amazon. Yep, Amazon. But people got to remember, Amazon stock, which went up like 4 or 5 fold in 1999, went down 90% from 2000 to 2002. And then of course it became the company it is today, which is a very valuable company. But we'll see the same kind of thing happening. And our job is to try and pick out of those equities, out of those stocks in the AI, which ones seem to be the more stable ones that are going to actually survive throughout the next number of decades here. Another thing that's happening that the Trump administration has promised to do is to lower taxes, or at least keep the tax cuts that they put that were passed back in the last administration of Trump's, that were supposed to expire. I think it's supposed to be at the end of this year, the tax cuts. But they've promised to keep those and extend those out further for the next 4 years. And lower taxes obviously just means more money is available for investment, and investment meaning corporate investment would be new plants, new ways of technology, certainly with wages of employees, stock buybacks, dividends. That all has a very positive impact. And if you look at the chart on the right-hand side of the page here, this is what tax cuts will do and the impact it has on GDP growth, which is the growth of the economy in this country. And it makes sense, right? The lower the tax rates go, the more positive effect it's going to have on GDP. And the higher the tax rates go, the more it sucks out of the economy. So lower taxes are good. One question that we got to watch for is, where does this money come from, right? You're lowering taxes, which means you're lowering revenue coming into the country, to the government. So where is that money going to be made up from? And what does the Trump administration sort of promise? They actually have a new department, with Elon Musk. Doge, right?
Yeah.
So what Brad Doge is supposed to do what? It's supposed to be.
It's supposed to reduce government spending to help to pay for some of these programs and to pay for some of the lack of revenue.
Yeah, so they're supposed to be cutting spending on Doge, and they said they can cut $2 trillion out. We're very skeptical of that, considering that most of the budget that's in place right now is on mandatory spending, like Social Security and Medicare, welfare, other programs that legally can't be cut. So, but I'm sure there's waste in there somewhere. And then the other thing they promised to do, of course, is tariffs. And that's taxes on goods that are imported to this country, which politically may be a thing that sounds nice, but economically tariffs, at least historically, tariffs have not done a very good thing. Usually, again, tariffs just sort of create strife among countries, as well as just increases prices of goods. So that plays through the whole inflation, the higher inflation, theme that we have too. All right, interest rate cuts. What's been going on with interest rates, Parker?
Fed's been cutting since the last 3 meetings. They've cut rates by 100 basis points, so they've been going down.
Yeah, so they've cut them by a full percentage point, which is 100 basis points, and it was at 5.5, and it's now at 100 basis points would be 4.5. What's the long-term average? We looked this up. What was the long-term average?
4.61.
4.61, and that chart went back how far?
1954.
1954. So the long-term average, and when we talk about interest rates in the Fed, we're talking about what's called the Fed funds rate. And that is the rate that the banks have overnight lending that the banks charge. So, and that's not a per night charge, that's an annualized rate. But, so if you look at the long-term average of 4.61 and we're at 4.5, we're about right where the long-term average is, and now we're looking at very, very carefully the political situation, because it certainly seems to us that if you look back at the last, call it 10 to 15 years, the Federal Reserve, which is in charge of interest rates, they can cut them or raise them. And, it looks like they get influenced very heavily by the political structure. So if you look back at the last Trump administration, go back to, say, 2018, Jay Powell at the time, because interest rates were at 0, and Jay Powell said 0 interest rates are not healthy for the economy, which they're not long-term, by the way. Certainly it fosters a lot of debt, and it also punishes savers, people saving money. So he started raising rates, and, the president didn't like it, and he started tweeting out, I don't want you cutting rate. I don't want you to be raising rates. I want you to be cutting rates. So eventually Jay Powell gave in to Donald Trump. And that's why the picture we have on here is it's a little funny picture, but, we think that, and it's not just Donald Trump, by the way. Any presidents tend to put pressure on the Fed to do things. And typically the Federal Reserve is going to fall under political pressure. because they're politicians, unelected, but they're politicians. So we expect, as long as the politicians want the Fed to cut rates, and it's not just the president, it'd be Congress too. As long as they want rates lowered. And why do they want rates lowered, gentlemen? What does it do to the economy? Lower rates.
It stimulates the economy.
Yeah, it stimulates the economy. And all you got to do is think of it in this way, right? Lower rates mean lower rates on mortgages. It means lower rates on cars, for car loans, for businesses, all kind of things. So it has a stimulative effect in a certain way. Now, when you cut them too much again, though, you start getting too much debt into the economy. So there's sort of a balancing act that goes in there. So we're just sort of following where the political pressure is going to come on interest rates. And interest rates matters a lot to how our investments are allocated. Because if you get to zero rates again, which we don't think it's going to happen, then that dictates a certain investment philosophy that we have to have. If you have rates at the 4.5% range, it's going to favor certain companies, favor certain kind of stocks, like dividend paying stocks still are attractive. So we're watching very carefully on what happens with the Fed and interest rates. What about the business cycle? Where are we, Brad and Parker? Where do you think we are with the business cycle?
I would say you can argue if you look at that chart, you can argue we're almost anywhere. You can almost argue that we're in almost any phase of that business cycle. I would have to say that we're probably somewhere between early and mid, but it's kind of hard to tell based on what stocks are doing, because it doesn't really fit with the normal business cycle. And I would, you can make different arguments as to why. One of them could be the amount of debt, and one of them could be the amount of increase, the rate of increase of our deficit spending over the last few years, particularly back during COVID. I think it kind of messed up the business cycle, so to speak.
What do you think, Parker?
Yeah, I agree with Brad. I'd probably say we're probably in mid. I'd say, but you could be anywhere except recession, I would say right now. Definitely not in a recession.
Yeah, no, you guys are right on. You're right on, because if you look at these sectors, it's interesting. And I'm looking at the chart on here. So, you look at financials, for instance, and this is the performance, of sectors during the business cycle. And we're talking about stock performance on here. So you look at performance as well as just economic performance, but they do tie into each other. So, financials certainly had a great year last year. You look at financial stocks as well as just the industry and financials. These pluses mean that's when they do well. So you look in there and say, well, it must be in the early part of the business cycle. Financials did really well. But then you look at something like utilities, which typically don't do well in the early part of the cycles. They do very well in recession. They had a great year last year, utilities. So you sit there and say, wait a minute, we're in recession. So we can go down the list with these, and it's kind of, Brad, you're right, Parker, it's all over the place in here. That leads you to kind of scratch your head and say, where are we? Certainly we would say we're not in recession. I think the numbers would bear that out. We're not in recession. We're growing at 2.5%, 3% for GDP. We're not in recession. Now, there may be some certain companies that are, but looking at just the overall economy, we're not in recession. It's hard to think of us in the early part of the cycle because we've been growing for years and years and years. I mean, the last recession that we had, well, if you want to count COVID for the 6 weeks, it was COVID for 6 weeks. But, if you take COVID out of it, which was sort of a forced recession, we were not in recession before COVID. We kind of forced the country to shut down. But if you look at it before that time, you get to go back to 2009. So we've been on this 15-year run as far as positive growth. So we're certainly not in the early part, it wouldn't seem like. So mid to late, but somewhere in mid to late. And, that would be our take on it. It's mid to late cycle. And so we're looking at the sectors that are going to be favorable mid to late cycle and more heavily weighted in those sectors, compared to the averages. Longer term outlook, that's sort of our outlook on 2025, but longer term, what do we see longer term, which we got to keep in mind too? More sticky interest rates, certainly higher than we had from 2009 to 21, which is pretty much zero. So we're not talking about 10% or 12% interest rates. We're just talking about more normalized rates, 4 to 5%. That would seem to be a more reasonable area to be in with interest rates over time in the longer term. What about a small cap rotation? We've not been heavily invested in small caps in a long time. What about small caps?
Yeah, but we recently increased our exposure to small caps a little bit. And I would say that two themes that would be positive for small caps. One is interest rates declining. The decline in interest rates is typically positive for small caps because small cap companies tend to borrow more money. But then also just the simple reversion to the mean. Small caps have underperformed for a long, long time. I think it's something like 14, 15 years that small caps have underperformed. And so, for those reasons, it's probably a pretty good time to start allocating a little bit more to small caps than we have in the past. I always tend to think a little bit from a contrary standpoint. And I actually had a very, very bright investor tell me they wanted to remove their small cap allocation from their portfolio. And that's, frankly, that's a sign probably of, the fact that now is probably a pretty good time to start allocating some to small caps. They just got sick of their small caps not doing anything. So,
yeah, for sure. It's hard to stay with investments that don't look like they're performing well when you see these other investments. And, our biggest weighting in our portfolios is still technology. Which has driven performance, and our performance has been very, very good with our portfolios. But at some point in time, you got to start rotating because it's not, these cycles still happen. So John Templeton said years and years ago, and I had the fortune to be able to talk with him back in the late 1980s, when he was still not quite, I think he was still managing money for some foundations. He had sold his Templeton group by that point. But when I had got on the phone with him a couple of times, one of the things he talked about was cycles. And I think he was in his 70s at the time. And he said, I've been investing for 50 years because I've seen all the different cycles that you can have. Large cap cycles, small cap cycles, interest rate cycles, foreign stock cycles, because I've seen them all. He goes, but one thing I've never been able to determine in all my 50 years of investing is when these cycles are going to change. When do these cycles change? And he was very famous for being very right. And he became a billionaire back when the billions were worth a lot of money back in the 1980s and 90s. But he was, but he was always early with his investments. So he got into the Japanese stock market back in the 70s before it took off in the 80s and became a bubble. But he made a lot of money in the 80s in the Japanese market, but he was in there early. And so he would see the cycles and he would say, this is really inexpensive. And then he would put money there and he may have to wait for a little while. So the challenge, Brad, like you're talking about the investor you're talking about, the client, it's just tough. It's so tough to watch something that doesn't go up. Yeah. Even though, eventually it's gotta happen. It gets so cheap that eventually there's got to be a rotation there because it's not like all those companies are bad companies. You get very good companies in there. It's just that the market's just not favoring it right now. They're still making money, but the market doesn't want it. So, our job for clients is to try and see as best we can where that turn is going to happen somewhere in there. And we're probably going to be like John Templeton. We're probably going to be early. Or Warren Buffett. Warren Buffett's also very famous for being early when he invests in things, but he's usually right eventually. So we're sort of that same way. So we see small caps this year. By the way, that small cap chart looks almost identical if you stuck an international chart in there. International stocks, foreign stocks are very cheap. And, if you go back to this chart here, again, they've been out of favor for a long time. So at some point in time, the tide turns. That's a DJ Global XUS right down there. At some point in time, that favor changes, and you see the global outperform, and that cycle's been happening for decades and decades and decades. All right, so are we in the Roaring 20s? Kind of seems like we are. Last couple of years, certainly. 2022 is a down market, but the last couple of years it seemed like it. So I pulled a chart out. It's kind of interesting. The last Roaring 20s we had was
1920.
1920s, 100 years ago, of course, 100 years ago. So, 1923, stocks were actually down 3%. Now in our Roaring 20s, they were up 20% plus, but 1924 was up 26%. And that would be akin to just the previous year, just in the 2024, we were up, 20% plus. If the market followed the pattern, in 1925, the market was up 30%. So we're not predicting up 30%. That would be a tall task. But that's what happened in 1925. So we think stocks will be positive in 2025. We don't think we're done with the AI revolution yet. And, so we would look for stocks to be positive in 1925. What will be your guess, guys, for the market for the 2025 performance stock market?
I'll jump in. The average return on the S&P 500 is 10%. I think that's reasonable. Although the index rarely returns the average. So it rarely returns in the area of 10%. I do think you'll see more volatility though this year. You can see more. I think you should. Last year, anytime you had a little bit of a dip, you didn't even get down 10% before the market recovered. You're talking 5-6% before the market would recover. I think you could see some bigger profit-taking situations this year, especially because the Mag 7 it did so well last year. You could definitely see some profit taking, but 10% or so I think is pretty reasonable, and that'd be a nice return.
Yeah, it would be a great return. What about you, Parker?
I'd say up 8%. I saw a chart the other day and it was talking about the first 3 years of a bull market, and on average, the third year does return about 8%. So it's going to be my guess. But it's interesting. I know I saw another chart the other day that the top 15 analysts on Wall Street for 2024 had the S&P 500 up 1% on average.
Really?
Well, that is interesting. That
And
is
it was
very
up,
interesting.
finished up 23%. So
They almost never say negative.
right.
Yeah, and so with the contrarian theme, by the way, because going into 2024, right, like you just said, all the thought was recession. Economy is going to really slow. So stock market's not going to do well. Well, just the opposite happened.
Yep.
So going into 2025, I think there's pretty optimistic scenarios going on with Wall Street across the board, with the Merrill Lynch's and the Goldman Sachs, and they all predicting pretty big gains in the market. And we're certainly not predicting losses. Like I said, to me, single digits seems like probably more reasonable. But again, the market on average over long periods of time has done, about 8%. So it's not like things are like an 8 to 10% return would be like bad. It's not. It's just when you're used to 20% in a back-to-back years. Brad, jumping on what you said, by the way, into 2024, we had 3 pullbacks in 2024. April, August, and December. In April, we were down 5% with the markets. In August, at 8%, that was a bigger one. And then December, 6%. Of course, we had a December pullback, but we didn't have any corrections. Technically, a correction would be between 10 and 20%. Those usually happen about once every the average, I think, is 1.2 years. Okay, so last correction we had was October of 2023. So we're probably overdue for one. And we don't like to see them. Nobody likes to see them. I mean, we all have 401k accounts. We don't like to see our account go down. It'd be great if it always went up all the time. But corrections and pullbacks are healthy for markets. Kind of weeds out speculation, washes out some of the excess in the markets, and then you kind of build from there. So it would not be surprising, Brad, to jump on what you said about volatility, to see the market a little more volatile this year, to go through a little more volatility this year in 2025.
I love the way you said that corrections are healthy. It's good for the market, because if it just goes up in a straight line, the inevitable decline becomes a little bit steeper. So a little bit of up and down on the way up is good, is not a bad thing.
Yeah, and you math majors out there, what a parabola is. So you get the one side of the parabola that goes up, and then there's a corresponding exactly the same going down. So like Brad said, if you got something that's going straight up, you're going to have something going straight down. So we prefer the markets to have this little bit staircase looking view, right? Where it goes up and then it's a little bit down, then go up and a little bit down. That's a healthier looking market. And there's another axiom that says markets go up an escalator and down an elevator. So we don't want the elevator. And we prefer the escalator. And then, if it's going to have a little correction, fine in there, and then move back up again. But we don't like the straight up and straight down. That doesn't feel good for anybody. All right. Anything else you guys want to mention? All right. Well, welcome to 2025. And again, Happy New Year to everybody out there. And we will see you all soon.